Good morning, everybody. Kirk Spano, April 21st, 2025. This is our weekly retirement income options and options selling webinar where I do a little macro. This weekend, I published my quarterly outlook, and uncertainty is the word of the year. If you are not a free subscriber to Fundamental Trends, you can get this at Fundamental Trends with an investment trends library membership. That would be this one. And we give you some things for free. We cover SPY and give you the macro and some general thoughts, including the quarterly outlook and game plan and the occasional special reports. If you want the stock picks and the ETF picks, then you'll want to add stock and ETF trends. If you want the options selling and the swing trading, then Rare Investor. Rare Lifetime gives you a few extra perks like 2 free consultations with moi. But for most of you, you're at margin of safety investing, and that's just dandy. It's everything that I do with the exception of the swing trading. So for most of you, Seeking Alpha's platform is great. All right, so I think that we are probably in some significant trouble here. The stock market is down again today, over 2% to the downside on both the S&P 500 and NASDAQ 100. They are pretty similar to the downside today. It had been that QQQ, NASDAQ 100, was more down lately than the S&P. And as those things even out, that will be a signal that the bear market is probably entering its final phase. We will see if this holds up, but I'm not sure that it will. The reason why that would be true, that as NASDAQ and S&P go down about the same amount, it means that the S&P 500 stocks are starting to capitulate too. We already know that the NASDAQ stocks have been heading down quite handily. In this quarterly report, I talked about fighting the Fed, basically not Fed policy, but just like fighting with the Fed, as President Trump has been doing. A number of people have weighed in on this, and frankly, I think this is very basic. If President Trump fires Jerome Powell, we are already seeing a flight out of American assets. It's not accelerated yet, but it is definitely happening, both in the Treasury market and in the stock market in particular. I think that the destruction of the dollar as a safe haven is a major strategic mistake, not tactical. Tactical is short term. Strategic is, taking a whole different direction. The idea that a weaker dollar will help exports has been wrong for a long time. I know that people want to say, "Oh, a weaker currency makes you export more." It just truly doesn't work that way. I know that in theory it could, but it hasn't, not this century. And the reason for that is technology. So the idea that weakening the dollar is good for us somehow is wrong. We will prove that it is wrong. Apparently, we don't like to take anything just based on logic and common sense. We're gonna fuck it up and see if people notice, and you will, because once the recessionary pressure is over with, which is what we're experiencing now, and that's why prices have come down on some things. They will lower interest rates. They will do quantitative easing. The economy will pick up. And then we are going to see the same type of inflation next year or the year after that we saw after COVID. During COVID, there was no inflation, was there? So there won't be much inflation during the recession. But coming out of it, with the way that they're doing things, we're going to see money printing without the return of investment from all of our neighbors. They may invest in the stock market, but I don't think they're going to buy a lot of our bonds until Mr. Trump is no longer the president. At this point, and I'm waiting for the funny memes that one of the last people that Pope Francis saw was J.D. Vance. So I'm just waiting for people to put out that J.D. Vance killed him. But there's not a lot of love in the world for Donald Trump or JD Vance. And I have a hard time believing that it's going to be all forgive and forget in the next few years. I think that there's going to be a scarcity of deals on trade. I think that Trump here might fire Jerome Powell. I think this is going to prove to be a pretty rough 4 years. There will be a major rally in the middle on the back of the quantitative easing that will come next year when we have a new Fed chairman. But between now and then, I don't know how far things can go down, but I did cover all the confidence charts. I showed that GDP has fallen off a cliff, and you can follow any sort of anecdotal evidence with travel or car buying or anything like that. The economy has slowed down dramatically. I don't see that picking up again until next year. And again, it'll be on the back of quantitative easing and stimulus, which will be inflationary at that point. So I did the bull, base, and bear cases for both the S&P 500 and QQQ. Here's the S&P 500. These yellow zones are very strong support areas in a bull market. If we break through here, which it looks like we're trying to do today, then that means we go down multiple different levels. So basically every orange line is a different support level. This is the long-term trend line. Can we break below it? Absolutely. There is a potential megaphone pattern over here, which means that we could see a price below this red line, potentially. The most likely scenario for the worst case, or I guess maybe the second worst case, is right in here. An S&P 500 around 3,000, SPY around 300. I don't know if that's going to happen. I think that there is pretty strong support around the 2022 lows, so 350s, 360s. I think this is the area that holds, but we will find out. If unemployment ticks up, then we'll get rate cuts. If inflation ticks up, then we won't. If both things happen, which would be stagflation, the medicine pretty much has to come out of Congress. And this particular Congress has shown a relatively high level of idiocy. So I'm not sure that they would do anything other than provide a sugar high that the very richest people in the country could skim out of. I am very pessimistic about what is going on right now. As you know, I started the year as neutral to bearish. I told everybody to raise cash just in case. And I think it is very important that you assess your risk tolerance for the next 3 or 4 years, not just this year. If we see a crash, a spike, and a crash, which I think is a situation that is developing and that I charted out on the QQQ, this ends up looking like a giant head and shoulders pattern, right? Shoulder, head, shoulder, which means that by 2028, we could be challenging the 2022 lows again. Here's what I didn't draw. I didn't draw an extension down into here. If this happens, if this breaks and gets close to the red line, which would be 2018 and 2020 levels, and we get a rally, probably doesn't go as high, and then it could come back down. So this is my base case, not too exciting for bulls, but this is a heck of a trade right here, right? So if we can catch this, if this is what happens, and then ride it up, then sell maybe in very early 2028 as it comes down into the election, which I think is a pretty plausible scenario. Now, people will tell me, oh, but Trump is going to pump things up into the election. Well, he might not be able to. If we blow our wad on quantitative easing next year, get a rally, and then there's inflation, that's just not a great scenario. And if our allies insist on being treated like allies and then we don't, what makes anybody think, especially after Japan kind of told us this today, that they're really going to come back in and buy our bonds and support our asset prices? Do you not think that they'll just try to wait out this administration and make sure that J.D. Vance or Donald Trump Jr. or whoever, anyone aligned with Trump, basically, is not elected president? I'm not sure how the international markets feel about Nikki Haley. I think that she would be the front runner of the non-Trumpers, although I think you could see Liz Cheney make a surprisingly strong rally if she is proven right, which I think she will be. I don't believe that most people understand the geopolitics here. And I think that most people are having a hard time because in their hearts, they know that there were some things that needed to get fixed. I learned way back in rhetoric class, took a few of them actually, and linguistics, that the way you say things matters. And by appealing to people's concerns, even if the solutions to those concerns that you offer are shit, which most of the Trump solutions are shit, you'll get support just by acknowledging people's concerns, manipulating them. I suspect that the House of Representatives is going to go heavily Democratic next year because in this country, we vote based on our pocketbooks. And when we feel pretty good about things, we generally are supportive of incumbency. And when we feel pretty bad about things, we generally support the loyal opposition. Loyal being an increasingly interesting word nowadays. I would be surprised if the House doesn't flip 30 or 40 seats towards the Democrats. And I would be surprised if they don't pick up a seat or two in the Senate. So what you see in the reconciliation bills this year and next year probably be the government that you get for the next 4, because in the second 2 years of Trump's term, he won't be able to accomplish anything. And I think that that explains the breakneck speed at which he is breaking things. And again, just so people understand that I am analyzing this, not just being emotional, because I do everything I can to avoid being emotional. I actually agree with a handful, not many, but a handful of the things that Trump is doing. The broad idea that the government needed a better organizational chart to be more efficient, better address needs, get rid of the waste that was in the government and the redundancy that was too redundant, right? I mean, you need redundancy, but not so much that it mucks up things and makes money just kind of disappear. The government needed to have a single-digit percentage of itself cleaned up, and it really was just a single-digit percentage. We've known that for years. 5, 6, 7, 8% of the government was waste and fraud. It's never been 20, 30, 40%. It's been some middle to high single-digit number as a percentage. I agree with cleaning that up. President Obama tried to do it. Republicans in the House told him no. President Biden actually had a couple of different things going to clean it up, but he got fought on it at every turn. And in fact, President Trump has just supercharged a couple of those things to the point where it's strictly about breaking it versus fixing it, whereas Biden was more measured. As an investor, I think it all comes down to a couple of equations. One, what is the government going to do with the money that it does have? And is it going to expand the deficits, which is what the Republicans said they wanted to shrink. If you study history going back to Ronald Reagan, you will notice that the Republicans have always said they want to shrink the deficits, and they never have. They have always blown them out every single time. Ronald Reagan, George W. Bush, Trump. Trump is probably going to blow out the deficit again here. George H. Bush, who had to go back on his no new taxes pledge, was the closest to not blowing out the deficit. Then, of course, the Democrats have been a mixed bag as well. Clinton did the best. Obama did all right. Biden, I give both Trump and Biden some pass because of COVID, but I think that we need to acknowledge that the biggest problem, which Al Gore addressed 25 years ago, still hasn't been addressed, which is the American retirement system. Until we secure Medicare and Social Security, which has to be done because otherwise you throw millions of people into poverty at older ages when they can't really do much for themselves anymore. And then they end up on welfare. So it's just a different expensive program. We're going to have problems until those things are fixed. I have proposed, and I have sent it to people who know people, some ideas. I know these ideas are not unique. I don't know if they fall on deaf ears, just, get ignored outright. But there are ways to fix Social Security that are relatively easy. Social Security is not that messed up. And people think that it is, but it's just not. Very minor tweaks will fix that. The healthcare system is different. And the reason I'm bothering to lay this out to you is because there is the potential for a positive surprise under Donald Trump. there is a way that he can fix a lot of things, because for the next 18 months, he's pretty powerful. I just want you to keep that on the radar. I don't think it's going to happen, but I am open to the idea that this administration does something wonderful if they recognize it as wonderful and are willing to do it. I'm not sure that they will. I'm hopeful that there's a chance, because Trump has said some things that make a lot of sense with regard to Social Security. He's not so good on Medicare. We will see if we get a positive surprise. I doubt it, but Trump is in such a powerful, unique position in history that maybe he does something well. Given that he's just taken the slashing and burning here in the first 3 months, I doubt it, but we need to be open, because if it happens, it'll be so positive. Because once we fix the retirement system, this country's in great shape again. Presuming we're not like stripping people of their rights and throwing our enemies in prison and things like that. Anyway, this chart, I think, is going to prove to be pretty accurate over the next 4 years. I hope that we hold this yellow zone that we're in now and we just resume the bull market, because that's better for everybody. It helps tax receipts, helps balance the budget. But at this point, I think this ABC correction down in here is the most likely scenario, with this not being out of the question. Remember, the United States, just in general, is the strongest place on earth economically. So even though they may be trying to break things and steal, in a few years, we probably would repair it. And that is important to remember as an investor, is that the United States has a self-healing power that is second to none on the planet. And at some point, it will kick in. My guess is it doesn't kick in until, maybe the day after a Democrat is elected president in 2028. We'll see. Last week, I sold some cash secured puts 2 weeks, about a week and a half ago, and I covered that. I think the place that you need to remember to invest are the places that have done well. So I'm writing this one, and here's the outlook so far. I'm being very cautious with my cash secured put selling. I've been going through my portfolios and doing everything I can to manage risk. I made one trade between Friday and today. I sold some cash secured puts on Flagstar, but sold the stock. So I was up on Flagstar maybe 5%. I took that profit, took the cash, then immediately sold $10 cash secured puts on Flagstar and got like 75 cents, on our 7.5%. So I will write that up and put that in here. That was just a way for me to create a gap of 12.5%, building a margin of safety based on prices, which is what margin of safety is. Margin of safety is being able to get in cheaper than what maybe you should be able to get in. So by using the option strategies, and remember, the reason I had to wait on this trade is because I had some covered calls expire on Flagstar. I think I'd gotten 70 or 80 cents on some covered calls too. That'll all go in here. I think that maneuver is one that you should all learn, is that when you get a rally on something that you like, but you're like, okay, it's, kind of getting fully valued for the next year, you sell covered calls. And then if you get a breath in the market where it drops a buck or two, which Flagstar did off its top in the 12s, I think it was. Now it's down at like 1050, right? You can sell cash secured puts at that point. So even though I sold that stock at 1050 or something, having a net cost of like 10, I had that other 70 or 80 cents, right? Other 7 or 8% from selling the covered call. So that ebb and flow trading, which is based on technical analysis, right? The sort of thing that Teresa does and that I do. Shooter's technical analysis is geared towards swing trading and scalping and day trading. Teresa and I are more position traders who try to squeeze money out of the middle of the market by buying and selling options, or else selling and then buying them back or letting them expire. Covered calls, cash secured puts. I think those are important trades for you. And it's important to understand that the things that did best in the last bull market, for the most part, will be things that do well in the next bull market. Typically, small and mid caps lead, and then the large caps jump on the second half of the bull market. So sometime later this year or next year, when they start spray painting the world in money, or at least this country, The small and mid caps that have been beat to hell probably do really well for a while. Then, because the world is full of indexers now, the large caps will outperform at some point. And they probably will outperform for longer than the small and mid caps do. Remember a couple of basic tenets. If the millennials like it, it'll be stronger. They are the marginal money, the money at the margins. If you're in business, you know it's that last unit that changes price. So you need to respect that the millennials are entering their peak earning years, just like the boomers 20, 30 years ago, and that they will start to drive things more and more and more. All this is recognizing how the boomers move the economy and how the millennials will now start to move it. We've been talking about this about 5 years now, and it's going to really accelerate over the next 5 to 15 years. Remember when you were a kid on the playground and you wanted a do-over? This is one of those occasions where you're going to get a do-over. So if you have losers in your portfolio, you don't hold on to them saying, oh, they'll come back. No, sell them and go and buy something better. And I'm talking primarily about large caps here. Large caps and speculative stocks. Know your stories. Understand what you're investing in. Twist my noodle a little bit that I get the same questions over and over again because people refuse to do the reading. As I have said, if you're not doing the reading, you shouldn't manage your own money. It is worth paying me 1% or somebody like me 1% to manage your money. When I say like me, I don't mean just any investment advisor. I mean a good one. And while I may not blow the doors off of things very often, I usually don't get my doors blown off either. I've only had like 3 big hiccups in my career. And I learned from them. What you need to learn now is a very simple lesson, and I gave it as an example to somebody on the telephone. Or maybe actually it was in person yesterday at Easter, somebody asked me. And I said, well, imagine that your household budget suddenly lost 10 to 30% of its income. You would have to tighten your belt. That is going on right now in capital markets for the United States because the international markets are pulling back on U.S. investment. So for every headliner who says, oh, look, NVIDIA is going to invest, or Taiwan Semiconductor is going to invest, or whatever, or SoftBank, the reality is that most of the deals that are getting announced were already partially in place. These are slight upgrades with no certainty that if they do come to pass will take a very long time. The money in the markets, the bond market in particular, also the stock market, is coming out of American assets. And for those of us who accumulated cash and continue to prioritize accumulating cash, I'm really hoping we get this rally, but it hasn't materialized yet. We should be able to buy a lot of good stuff cheap. We're going to get a redo. You want to focus on the things that did well in the last cycle. Quality and growth. Those are the 2 things to look for. Beta, which you want to reduce going into a correction, you want to increase coming out of the correction. For as painful as beta is on the downside, it is that awesome on the upside. You don't want to buy slow growth, strong dividends, buy dividend yield. You want to buy the best businesses with the most upside coming out of a correction because some of them will double or triple really fast. I haven't written the article, but I probably should. But the working title is Forget 80% of What You Know About Investing. Another article that I have on the agenda is Ignore the Cheerleaders, Learn the Game. There's so many cheerleaders out there. Oh, my high yield portfolio averages 8% dividend. Yeah, but your stocks are down 20, 30, 40%. Enjoy getting your money back, but taking 5, 6, 7 years to do it. I do think a lot of the losses people suffer this year, they will not make back until the next decade. I do know that a lot of baby boomers were early in getting out of the stock market. They were selling last year, and a lot more jumped on the bandwagon in Q4 last year and Q1 this year. I know this because I added accounts. I have one account where he gave me, I think, 1.2, 1.3 million, and I left about $1 million of it in cash for months. He's like, and I didn't even charge him a fee on one of the accounts. I was like, yeah, I'm just sitting in cash. He goes, how did you know to do that? I've been explaining it to you for months and months and months. Blanket tariffs are generally a bad idea. We got rich without them. The dollar has helped support your standard of living and mine because we could buy a lot of stuff on the cheap. If the dollar devalues by 30%, that essentially means that everything that you buy is going to be more expensive. And the things that are tariffed on the way in, has anybody gone and looked at the price of olive oil, will be more expensive because of that too. I bought a bunch of avocado oil yesterday at Costco, or 2 days ago at Costco. I went to Costco the day before Easter on a Saturday. It was surprisingly not as busy as you would think a Costco would be the day before Easter. I don't know what that means. Maybe everybody had gotten it out of the way during the week. But I bought a lot of avocado oil because it'll last a year. Put it in a cool, dark place. And I cook with that. I have just resolved myself to the idea that I will be paying 25% more for olive oil for my salad dressing. That doesn't keep as long. You really can't stock up on that, even if you buy it in the can. Life is going to get more expensive, folks. It might not right away because the economy is slowing down and we're going to burn off inventory. But once the inventory is burned off and they start stimulating, if they keep the tariffs, we will get inflation. And if they blow out the debts, we'll get inflation. I came up with a title in my head yesterday. I got to remember what it was. That describes what's going to happen with inflation. First, it's going to go down because the economy slows down, but then it's going to go up because of all these other things. And there's a trade in that. So look for covered calls to sell, stocks to trim. I gave you one already to trim. Not that I don't like Flagstar long term, but I'm looking for ways to peel out 5% or 6% or 7% where I can, because all those little trades add up. And I want to have a lot of cash to buy whenever it is this bottoms out. And we will see the telltale signs of exhaustive selling when it happens. I think the selling is still accelerating. And I'm taking a look at some of the energy stocks. That's the last thing I want to show you is this Permian Resources chart. People look at this, right? And they do the 1-day chart. And they do this. And they go, oh, it looks like that's about to rebound because look, it's hitting this support zone on the daily chart. Okay, take a look at the weekly chart, and I do think the longer term charts are in play here. Does this not look like it could come way down into this area, 8-ish? That is one of the support levels. So this does not look like it's going to hold, does it? So then it could come all the way down to 8. Now, I sold the $10 puts the other day, got $1. So my average price would be 9. I can probably tolerate that, even if it goes to 8. Here is the big problem with energy. If the economy really does tighten up and there's no attack on Iran, then these stocks can all come probably not down to here, which was the COVID oil at 0. But see kind of this area here and this area here. We could get all the way down to around $5 on Permian Resources. I don't think we will, but we could. The interesting thing about energy at this point is that if there is an attack on Iran, and remember, the Israelis want it, and President Trump just doesn't want the price of energy to go up much. So if he's convinced by the Saudis or the oil industry that, hey, go ahead and do what you need to do with Iran, we'll be fine, then expect the B-2 bombers that are amassing at Diego Garcia, I believe that's where they are, to get up in the air. That is where they are, right? Diego Garcia, 4 hours from Iran. All right, so the energy stocks I've been mentioning that are on the punch card dividend list, take a look at those. Take a look in particular at the one that is north of the border. Take a look at Matador. Take a look at the ones that we already own, including Permian Resources. That basket, I think, will be very exciting if we get one more selling event or two. This is the ETF that I would buy. Look how it got down. It's almost at that level. I identified this level a long time ago. If it doesn't hold, then I'm gonna leave this on here. I'm gonna get rid of that. Right? I identified this level as a support, just bounced off it, and that's a pretty good chart. And we'll see if it breaks through and gets all the way down into here. So if we get a bottom on energy that is driven by economics, just understand that like everything else, it's high beta, so on the way down it sucks, but on the way up it's awesome, as you saw coming out of this. I mean, this stock from its bottom was up 1,000%, or this fund was up 1,000%. So our job with energy, which is high beta, is to figure out where the bottom is. I don't think it's 2020 low, because things won't fall off the cliff that much, right? We're not going to turn off the world. We're just going to slow it down. But these are probably doubles and triples on the stocks, and this will probably beat the S&P 500. So if this is where the bottom is, the S&P 500 and this you'd want this. It'll beat the S&P 500 coming out because it's higher beta. Interestingly, there might still be a trade in copper. I don't know if you were all paying attention. FCX. What was the big copper news this week, Les? I'm sure you saw it. BHP and Rio got fast-tracked yesterday or today or sometime recently on a mine in Arizona. It is going to be a gigantic mine that can provide about 4 decades worth of copper. I think like a quarter of the copper needs of the country for 4 decades. I mean, that's a lot of copper. One of the buildings near Intel is actually a Freeport-McMoRan building. If we get a big sell-off in copper, then I think Freeport-McMoRan is the one to buy because it's always been. But if we get down into this area, now see, it says it's kind of got a buy signal. I think that little jump up was the buy, and I think it comes down to here. And the question is, does it come all the way down into here? I don't know. But around 20, Freeport-McMoRan is pretty interesting. All right, just pull the chart out. You know, you got these peaks. You can buy it down around here. It's a pretty good buy. You buy it down around here. It's an awesome buy, right? I don't know if that's going to happen, but if it does, you buy it because it's a heartbeat. And the new mines take 10 years to get off the ground, right? So even though there's news about permitting a new mine, you know, it's not going to help us until the next decade. So keep your eye on Freeport-McMoRan. If we get a price down in here, you close your eyes and you buy it. Some of these cyclical trades, and I know people, I want to buy something I can own forever. Dude, that's just index. It doesn't work that way. Forget that idea. Think in 2, 3, 4, 5 year periods. It's the best that you can do. And understand that certain things, because of their beta, because of their inherent volatility, you sell after big rips and you buy after big corrections. And you can probably make a lot more than the index and almost everybody else who's just selling fear and buying greed. It's supposed to do it the other way around. All right, any questions about anything in particular today? I know 3 of you are thinking it. Don't say it. Anything in particular? No? Yeah. So Bitcoin is interesting. That is, I think, all the evidence you need that the millennials are very, very important to this market, right? Very, very important. Last week in the chat room, I said, I'm really thinking about Bitcoin again. I don't know if there's going to be a correction. Shooter does. So I'm not ready to get in there yet because I think as the liquidity gets sucked out of the system, that affects everything. And I think you're going to see a massive sell-off of IBIT and the other Bitcoin ETFs. And when that happens, that's probably the time to buy. As far as gold, I think the gold rally is almost spent, mainly because it's outperformed SPY for the last 5 years, which is very unusual. And historically, the price of gold reverts to about 30% above the cost of production, which would put it, you know, at 14, 15, 1600. I think that 1900, 2000 range, though, is probably what holds because that was the resistance that it hit twice before finally breaking through. So I think the floor on gold is around 2000. Could it spike up higher on stimulus over the next few years? Yes, it could. And that might be the last hurrah. So if you are riding gold, I'm not selling mine. I have some in the 401k plan, but I really don't know that it's a buy right now. I think it's just a hold. I think all of the energy stocks are good. You just have to find where it looks like their bottoms are. We have a couple that look like they're around their bottoms, and I think the other ones will join them soon. When they do, you may want to, you know, go triple or quadruple weight on energy in your portfolio. What is energy as a portion of the S&P 500? 4%. So that means you could go up to like 16, maybe even 20% energy. And then be diversified in what your energy is, right? It doesn't have to all be oil. Spread it around the energy sector. Les mentions the high tension wires going up in Texas. It's happening all over the country. That was the whole thesis behind We Energies, right? I've told you about this one a couple of times. Back here. You know, so when it was around 80, I pointed it out. Now it's 100. And it's just a utility. I mean, it's only up 25% plus the dividend. But, you know, that's pretty good for a utility. You should expect it to be range bound, though. It's near the top of its channel. It's going to probably come down. But these guys own American Transmission Company, and they're putting up the wires all over the Midwest. So as a utility, it's probably not worth this. But when you add in their majority ownership of American Transmission, it is. And people don't pay attention to that. That's actually the most important part of their business as far as I'm concerned. Because I'm not generally interested in utilities. When utilities lead, that means things are bad. But these guys have an unusual growth driver that other utilities don't have. All right, let's call it a day. Everybody have a wonderful, wonderful week. And I will get this option article out, and I will put the video link in it as well. I'm taking a look at growth stocks. I'm not in a hurry, but there will be 4 or 5 new growth stocks in the list on Punch Card Growth Stocks when I get that update done sometime this month. And the Global Trends ETF, which just hasn't changed much in a few months, I will do an update just because, it's a new quarter. All right, everybody, have a great day, and don't believe the hype. The cheerleaders are not steering the bus. They are not making the plays. Learn the game. All right, everybody, take care.